Well, our next guest believes just the opposite, basically. He says a trade deal is coming and to buy stocks now because the rally is alive and well. Let's bring in Steve Chiavarone, the portfolio manager at Federated Investors. Great to have you. Your year-end price target is 3,100. Yeah. So you really believe that this is trade going to be the major catalyst here for 3,100?
The Fed has been the major catalyst. They're underwriting an upward movement in risk assets by taking a policy error off the table. You know, we were here a month ago, and the idea was, and it still is, the market was pricing in a recession in Q4. That's not going to happen by any of the measures that we look at. And if you don't have a recession, the bull market shouldn't die. By definition, if it's still a bull, you got to hit a new high. And we believe, look, you guys are the traders, I'm the investor. I don't know what the next 2 or 3% move in the market is, but we feel really good that the market's going to hit a new high in 2019.
How do you account for slowing economic growth around the world? I mean, we were talking about this UBS downgrade of Caterpillar. I know you don't talk individual stocks, but this sort of underscores the notion that there is concern outside of a trade deal happening, that growth overall is slowing. That's going to hurt end markets for U.S. multinational companies. And from your standpoint, that could be a sign that you might want to worry about companies and how they're doing around the world.
Everything you said was right, but I'd change one word.
Okay.
Growth isn't slowing, it has slowed. And we believe that it's going to. No, it has slowed, right. And we think it's bottoming in Q1, and then we'll reaccelerate later. And that slowdown is causing the central banks of the world to go from kind of synchronized tightening to synchronized stimulus. And that's the part of this story that we think is different. We're at 2,800 today on the S&P. We were at 2,800 5 months ago. But instead of being at peak earnings and peak growth ready to decelerate, we think we're bottoming in earnings and growth in Q1 and reaccelerating. We think that you're paying 16.5 times now. You were paying 18.5 times 5 months ago. The Fed's no longer in play. All of that suggests to us that this 2,800 is more attractive than it was in October.
You know what's so interesting about what the totality of what you said is that basically you're saying that in the U.S. we've taken a policy misstep off the table or we will when we have a trade deal. The Fed is out of play, so the Fed misstep is out of play either. But yet you're putting your faith into central banks around the world who can stimulate those economies around the world to prevent us from feeling the pain.
I don't think it's faith. I mean, China threw more money at their economy.
But you're worried about the missteps here in the U.S., but you're not worried about the missteps in Europe or in China in terms of holding the
we were not worried about the missteps last year. That's why we remain bullish. We believe that in the face of that growth slowdown, regardless of the fact that Powell was kind of finding his way to the right rhetoric, that ultimately the Fed wasn't going to hike our way through into a recession. And we don't think the rest of the central banks are interested in killing themselves either.
Was it a policy error because it made the markets go lower, or was it a policy error because it did something to the economy? Because in my world, the president talks about the greatest economy in the history of the public, record unemployment rate, stock market within a few percent of an all-time high. Yep. Fed's just trying to get to some level of normalization. I don't know why that's an error.
Well, right. The Fed has mandates of maximum employment and stable inflation. One of their mandates is not to just cause a recession because. And so if they were in a scenario where housing was coming under pressure, autos were under pressure, interest rate parts of the market were a little bit weak, the dollar was strong, global growth is slowing, and their hand isn't being forced by inflation, then why? If slowing down today means that they make the expansion last longer and can get 1 or 2 more or 3 more hikes over the next couple of years, that's a better trade-off. Yeah, you want dry powder, but you don't want to need it sooner than you have to have it. And so we think that it was just a matter of looking at the risk and return and saying, we don't need to be crazy here. If you don't have a Fed hiking and you don't have a policy error, it's hard to get to a recession. All recessions have that.
So, Steve, based upon dry powder concept, where do you put money to work here? Because you're going to 3,100. Most people would say we're going to need to see the same horses ride on, and those horses would have to be mega cap tech and ultra cyclicality. Is that where you're putting your bets right now?
We think the easiest money to be made right now is in the United States. Cyclicals, small caps, interest rate sensitive parts of the market. Because all you need is no recession and the Fed to do exactly what they said they were going to do, which is nothing. If I go internationally, I need the trade war to go right for emerging markets. I need the dollar to weaken for emerging markets. I need Europe not to be Europe.
You just said the trade war is going right.
I know, but it's still something else that I need. Whereas in the U.S., in terms of easy money, if all that we do is the Fed doesn't, do another about face and a recession doesn't come, we've had parts of the market that were down 25, 30%. And this is energy, industrials, materials, financials. We think that, along with small caps and dividend plays, are your easiest money in the market right now.
Steve, great to see you. Thank you.
Thank you very much.
Steve Chiavarone, Federated. What do you think?
Well, I think that industrials, I agree with most of what he was saying. I think industrials are overbought, so the market can move sideways and lower. As he said, he's not forecasting the next 5% move. He's forecasting it for the year. I think industrials are overbought. I think tech is overbought. I think you got to go away from those.
The question is, are we in this place where this market is not where it was in the first couple months, first month really of 2018 or the last part of 2017, when we were rallying on earnings growth and we were putting our investments into those sectors where you're getting it? Everything I'm hearing from anybody who at least is talking about an earnings recession says this is a market that looks a lot more like 2015 when we really hadn't recovered, and we're buying the market because there is no alternative.
I still think you just look at the stocks, like we just basically heard, if the fundamental story is there and they've got growth, and if they're trading at PEs that absolutely seem still very cheap, I think there are great opportunities out there. I think there are names in technology that aren't the big four or big five that actually fulfill a lot of that. So I think there's all kinds of different opportunities out there, Mel, that actually still have room to the upside, that give us a nice push, that get us to that 3,000 level in the S&P.